Brad Williams, Frugal Finance, plain vanilla currency swaps. In a plain vanilla currency swap, one party typically holds one currency and desires a different currency. The swap results when one party provides a certified principal in one currency to its counterparty in exchange for an equal amount of a different currency. Each party will then pay interest on the currency it receives in the swap, and this interest payment can be made at either a fixed or floating rate. For example, party C pays a fixed rate on dollars received, and party D pays a fixed rate on euros received. Party C pays a floating rate on dollars received, and party D pays a fixed rate on euros received. Party C, number 3, pays a fixed rate on dollars received. Party D pays a floating rate on euros received. Number 4, party C pays a floating rate on dollars received. Party D pays a floating rate on euros received. Although all 4 patterns of interest payments are observed in the market, the predominant quotation is of the second type. Pay floating on dollars, pay fixed on the foreign currency, and this is known as a plain vanilla currency swap. Before analyzing the cash flows on the plain vanilla currency swap, floating rate on dollars, fixed rate on foreign currency, we begin with a simple case. The simplest kind of currency swap arises when each party pays a fixed rate of interest on the currency it receives. The fixed for fixed currency swap involves 3 different sets of cash flow. First, at the initiation of the swap, the 2 parties actually exchange cash. Generally, the reason for the currency swap is because the company needs funds denominated in a different currency. This differs from interest rate swaps in which both parties deal in single currencies and can pay the net amount. Second, the parties make periodic interest payments to each other during the life of the swap agreement. And these payments are made in full without netting. Third, at the termination of the swap, the parties again exchange the principal. As an example of the fixed for fixed currency swap, let's assume that the current spot exchange rate between euros and dollars is euro 0.8 per dollar. Thus, the euro is worth 1.25. 1 divided by 0.8 is equal to 125. We assume that the U.S. interest rate is 10% and the EU interest rate is 8%. Party C holds 25 million euros and wishes to exchange those euros for dollars. In return for the euros, and Party D would pay $31.25 million to Party C at the initiation of the swap. We also assume that the tenure of the swap is 7 years and the parties will make annual interest payments. With the interest rates, in our example, Party D will pay 8% interest on euro 25 million it received. So the annual payment from Party D to Party C will be 2 million euro. Party C receives 31.25 euro 25 million divided by 0.8 million US and pays interest at 10%. Party C will receive 3.125 million each year to Party D. As the payments are made in different currencies, netting is not a typical practice. Instead, each party makes the full interest payment. At the end of 7 years, the 2 parties again exchange principal. In our example, Party C would pay 31.125 million. Party D would pay 25 million. This final payment terminates the currency swap. At the end of 7 years, the 2 parties again exchange principal. In our example, Party C would pay 31.25 million and Party D would pay euro 25 million. This final payment terminates the currency swap. Figure 20 shows the cash flows on this fixed for fixed currency swap from the perspective of each party. At time t0, the principal amounts are exchanged. At the end of each of the 7 years, the fixed interest payments are exchanged. Finally, at the end of the swap, t is equal to 7, the principal amounts are then exchanged. Ignore the LIBOR, doesn't mean a thing. Okay. So here we're just exchanging. It's just simple. You give me 2 million, I'm going to give you 27 or whatever the exchange is. When this fixed for fixed currency swap is negotiated at time t is equal to 0, the entire sequence of cash flows is known for the entire tenure of the swap. Which set of cash flows is more desirable? Only time will tell, because interest rates for the dollar and the euro will fluctuate, as will the dollar-euro exchange rate. Like the plain vanilla interest rate swap we've considered, the fixed for fixed currency swap is a zero-sum game. One set of cash flows will turn out to be better than the other. The party that gains does so at the other party's expense. As noted above, the fixed for fixed floating currency swap is the prevailing type of currency swap and is considered to be the plain vanilla currency swap. In this type of swap, parties typically exchange principal at the outset of the swap, but one party pays the fixed rate on the interest on the foreign currency it receives, while the other pays a floating rate on the currency it receives. As an example of a fixed for floating plain vanilla currency swap, consider a swap arranged between a U.S. and Japanese firm, assuming that $1 million is worth yen 120 when the swap is negotiated. Let the notional amount of 10 million in yen 1.2 billion with a tenure of 4 years based on annual payments. The Japanese 4-year fixed interest rate is 7%, and the U.S. firm promises to pay this fixed rate. For its part, the Japanese firm promises to pay 1-year SOFR rate, which is currently 5%. Table 20.3 shows the anticipated cash flows. Customarily, foreign currency swaps are determined in advance and paid in arrears, just as we've seen with interest rate swaps. However, foreign currency swaps can sometimes be in advance swaps as well. Figure 20.3 parallels table 20.3 and shows the cash flows on the plain vanilla currency swap from the perspective of each counterparty. Here we have SOFR, that's recognized, and then we have no idea what the future holds. A floating rate obligation pay party B, you have 1.2 billion, then you have SOFR times 10 million. Fixed obligation, party A pays party B. Got this? And then here, ignore LIBOR. All right, just put SOFR if you want. And this is just an overview, the exchange, really. You can call them swaps, but it really is an exchange. You're going to pay me fixed. You're going to receive floating. You're going to pay floating and receive fixed. Exchanging A for B. Pretty straightforward. And read this information. Brad Williams, Frugal Finance. Thanks for watching.